Hi everyone, welcome to today's class. Today we're going to see transfer pricing. Okay, so what is the meaning of transfer pricing? So it is the organization as a multinational organization and are operating in an environment of unprecedented complexity. Okay, the rising volume and variety of intercompany transaction and transfer pricing regulations, which is accompanied by increased enforcement activities. So in this, worldwide have made transfer pricing the leading risk risk market issues. So by this, the transfer pricing refers to a value attached to the transfer of goods or services between the related parties from buyer to seller or seller to buyer. Okay. So thus the transfer pricing can be defined as a price paid for a goods transferred from one economic unit to another. So assuming that two units involved in are situated in a different country but belong to the same multinational firm. So these countries all over the world are applying greater scrutiny and calling for a stricter regulations on a transfer pricing practices. So however, this greatest can provide an opportunity to identify more cost effective arrangements for your international transactions. So based on this, new transfer pricing self-assessment regime is placing a greater burden on the public officer to sign the income tax return to confirm that the related party pricing is a arm's length and is supported by good quality transfer pricing documentation. So by this, the failure to adequate transfer pricing documentation can result in higher tax penalties in the event of Australian tax officer, okay, ATO. So at this global level, there has been a rapid introduction of a new transfer pricing regulations from Organization for Economic Cooperation and Development, particularly on intellectual property as a part of real-based erosion and profit shifting initiatives. This will have a substantial impact on a current and future transfer pricing structures of the all sizes of businesses. So by this, which we're going to see is arm's length principle applied in transfer pricing. So this principle is applied for both context of a transfer pricing and attribution of profits. So such as the application makes no distinction between a brand, a subsidiary through which MNE carries the business in a country. So a functionally separate entity approach as a working hypothesis underlying the application of the arm's length principle is found almost all treated. Okay, so by this the transfer price is not arm's length price. Why it is not arm's length? Because it is the price charged in the transaction. Transfer price is charged in the transaction. The term transfer price is used to describe the actual price charged between the associated enterprise and internal transaction, and transfer pricing issues arises when entities of the multinational corporations residents in different jurisdiction transfer property. Okay, so where the transfer price is different from the price which would have been charged if the enterprise were not associated with a different gives rise the tax advantage. Okay, the tax is calculated on the basis of the arm's length price. In this we're going to see aims and objectives of transfer pricing. What are the aims and objectives? The first one, excuse me, so transfer pricing minimizes the tax burden and arranging direction of a cash flow. So how it is refers to the value attached to the transfer of goods and services, technology between related entities, or such as parent, subsidiary, corporations, and also being the parties which are controlled by common entity. So its essence being it pricing is not a set of an independent transfer and transferee in an arm's length transactions. Second one is transfer pricing results in shifting profits. So whatever the reason of fixing the transfer price, which is not an arm's length, the result is the shift of a profit. The effect is the profit appropriately attributable to one jurisdictions. Okay, so is shifted another jurisdictions. So the main objectives is to avoid tax is also to withdraw profits, leaving very little for the local participation to share. So other objectives avoidance of foreign exchange restrictions. Next one is Shifting of profit tax, avoiding not the only objects. So by this transfer becomes the enterprise under same control management of good commodities, merchandise, raw material, stock, services is made at the price which is not dictated by the market and but controlled by such consideration. So by these considerations all to reduce a profit artificially so that the tax effect is reduced in a specific country. So to facilitate decentralization of a product so that efforts are directed to concentrate profit in the state of a production. The third one to remit profits more than sailings imposed for repartitions and to use it an effective tool to exploit the fluctuations in a foreign exchange to advantage. Okay. So next one is hedging. Hedging foreign exchange exposure. So treating a foreign exchange risk is normally achieved with the sum of from the hedging. Okay, so this commercial non-financial business typically use a mix of the following forms. The first one is natural hedging. So this means I already explained this, I think so. It's okay, we can go through. So this means buying in the same currency as a sales or in. So although this sounds like an easy solution, okay, so it is normally not effective because the suppliers customers may price fixed exchange risk result for themselves higher than the business itself. So the natural hedging is often inflexible because the required commercial agreements are typical harder to change than buying and selling currencies forward. Next one is loan hedging. So loan hedging means it is possible to hedge currency sales. So by following the sales currency, okay. So and to deposit purchase currency for the opposite reason. So in practice, access to sufficient credit lines and large loans to the deposit spread makes this an expensive way to hedge. So it may make sense where funding is anyway needed and a currency loan can hedge for recurring business. This can also be useful where the forward market is not existent, okay, or severely restricted. Then the third one is forward hedging. So forward hedging nothing, this refers to selling the exposure currency forward against the base currency for sales and future inflows and the opposite of the purchase and outflow. So this is normally most cost efficient and effectively ways to hedge foreign exchange risk and is described the more detail below. Okay. Then last one, option hedging. So option hedging means it is a hedging the fixed exposure using fixed foreign exchange options. Okay. So it is not uncommon in the commercial business to hedge special situations such as bids, tenders where the foreign exposure is the material but uncertain. So for normal future section, options will always be more expensive than forwards over time because the option buyers pays the premium for flexibility they do not use if they have no market views. And the next one is how transfer pricing helps. Okay, by preparing transfer pricing documents in accordance with new Australian self-assessment regime. Okay, this address of ATO 5 key questions on transfer pricing and allows the payer to achieve the reasonably arguable positions. And the next one is assisting with the preparation and review of the international dealing the schedules and working holistically to understand the future strategy, assisting the response to an ATO risk and obtaining advanced pricing agreements and helping groups with the ability to prepare and comply with the rules applying accounting periods commencing after 2016. So we can help the clients consider upfront the impact internal transfer pricing risk. So how these may be addressed. So we can also assist the compliance in preparing a country by country report. So master file and Australian local file. So by this unit 3 is over. If you have any doubts, please comment below or text me in a WhatsApp. I'm here to help you. Thank you for listening. Take care all.